Economic storm clouds still gathering, and Canada's bank regulator is considering stricter capital rules. And some analysts say this could force Royal Bank to issue new shares, and that may not be popular with investors. The stock is actually down over the past year. We're joined by Bloomberg's Stephanie Hughes. Steph, great to see you. Could you walk us through what we may expect from these new capital rules?
Sure thing, Andy. So to catch viewers up to speed, analysts are widely expecting that OSFI will raise its minimum capital requirements in December as it reviews regulations. So as it stands, banks have to have a common equity tier 1 ratio of 11.5%. Simply put, that's a measure of a bank's financial strength in the face of downturn risks. And in the current macroeconomic environment, there have been quite a few of those. So this CET1 ratio I just described could rise to 12% by the end of the year, which would definitely add some pressure to banks to clear that higher hurdle there.
And so they're not satisfied. They have been tightening up over the years, but why would they want to make the rules even stricter?
Well, there's been concerns about a slowing economy, rising interest rates that could put more pressure on borrowers. But some analysts that my colleague Jeffrey Morgan and I have spoken with really pointed out RBC as one of the banks that might see some greater pressures there because of their $13.5 billion acquisition of HSBC Canada. So putting more capital aside towards that deal, there's a potential scenario that some of these analysts raise that RBC might have to, sell more shares, sell some shares to actually be comfortably clear of that 12% threshold. Now, it wouldn't be the only bank to do so. Viewers may recall that BMO did something similar late last year when it sold over $3 billion in shares after OSFI delivered that surprise 50 basis point hike in its capital requirements as it pursued the Bank of the West deal. So one of the solutions, not the only solution, another potential solution that a portfolio manager raised is that it could hack away at some of the riskier HSBC loans.
Why are people interested? I mean, RBC, how badly would this go down with investors if RBC was to come to market with the stock having done nothing over the past year?
That's a good point. I mean, the banks have been lagging the broader TSX. So I think for investors, this may signal perhaps a bit of struggle, but the spokespeople at RBC have assured that they are currently clear of that 12% threshold with the CET1 ratio at RBC being 14.1%. Not only that, but during the last conference call, Chief Financial Officer Nadine Ahn did say that they do intend to, or they do absolutely see themselves being well clear of that ratio even after the HSBC Canada deal closes early next year. So there's been some moves on the part of RBC to assure investors that they will be on the right side of regulations here.
Stephanie, fascinating story. Thank you very much indeed.